Good morning and welcome to Financial Accounting. We are almost at the end of the semester. So as we look at our calendar, you can see we finished chapter 13 on Monday. So the chapter 13 problem ideally should be submitted for grading by the end of the day today. We do, however, have a drop-in review session scheduled for tomorrow afternoon. I scheduled that for 2 o'clock. So hopefully, if you need assistance with that problem in particular, that would be a good thing to attend that drop-in review session. I will record it, assuming that we have people there and that there's something to record. So if that's the case, I will record the session and post that, and of course, post an announcement once that is available for you. So 2 o'clock tomorrow afternoon. If you want to attend some or all of that, please sign up in Starfish so I know who to expect. We're going to be starting chapter 14, our final chapter in the financial accounting half of the book. So for many of you, you'll be taking managerial accounting likely next semester. And in managerial accounting, we start in chapter 15. So it's the same book. If you have me for that class, it will be the same format basically as what we have in this class, that we will cover chapters 15 through 28. You have the 10 exercises, a pre-quiz 10 exercises, one problem for each of the chapters. The main difference between, for my class, the main difference between financial and managerial accounting is rather than having the 5 little mini projects throughout the semester, there's just one big project that kind of pulls all of it together. You'll choose a new company, not the same company you had this semester, and do one complete project that's due about week 10 in the semester. So I hope to see some of you in managerial accounting in the fall. So we'll start chapter 14 today. As I said, we'll finish that up on Monday. That will be the last new material class day. Wednesday then at our regular class time, Wednesday the 11th, will be day number 30 for class. It won't be a formal class, but that will serve as our final drop-in review session for the semester. So if you do have any questions, anything you need to cover with me before the end of the semester, before you take that last exam, then you should plan to attend class on Wednesday the 11th. I will be in the classroom. I will connect on Zoom. If you don't have questions, unless you just want to hear what anyone else might talk about, you really don't need to attend on May 11th. There will be no new material covered that day. Friday the 13th then is the final day of the semester. So that's your last chance to turn in any outstanding work. Anything you've been working on in Cengage and thought, oh, I'll get back to that to bring my grade up a little bit. If you haven't submitted it for grading, you need to do that before or by the end of the day on Friday, May 13th. The final 2 assignments, of course, are the last piece of the project and then the last exam, which just covers chapters 12, 13, and 14. It's not a cumulative final exam. It is very similar to the 4 other exams you've already taken this semester. Questions about anything coming up? Okay, we'll just get started then with our final chapter. So there is some new information, some things that we haven't already alluded to in earlier chapters in this chapter, but quite a bit of what we will do in this chapter is information that we have So I apologize, I just paused the recording for a moment. I don't remember exactly what I was saying before I paused, but some of the information in this chapter is new to us, and some of it is information that I have mentioned or we've discussed in earlier chapters, but maybe haven't actually looked at the calculations yet. And some of it will actually be review of calculations we've already done, such as the current ratio. So if I can get, there we go, to change pages. So we have 6 learning objectives we'll be talking about in this chapter, but they're really all of one piece, which is how do we, now that we've spent 13 chapters learning how to create financial statements, the reality is most of us will not be involved in actually creating financial statements in our jobs, in our workplace in the future. Many more people use those financial statements than there are people involved in creating them. And so the focus of this chapter really is on how do we use this information now that we know how it's calculated, how it's put together, what it means in terms of the GAAP, generally accepted accounting principles. Our focus shifts to now we have a prepared set of financial statements in front of us. How do we make decisions about our company? So it circles, and I hate this expression, but it circles all the way back to chapter 1 when we said people, the reason we do accounting, the entire reason accounting exists is to help decision makers make decisions. And so again, our focus in this chapter is how do we do that then? Now that we know what's in there, how do we use it? So you can see 6 learning objectives on this page. There are 2 appendices to this chapter, or to this chapter, but we will not be covering those 2 appendices. You'll notice, I just want to point this out, in Appendix 2, there's reference to comprehensive income. So some of you have had a conversation with me about comprehensive income in a very generic way because you noticed a 5th financial statement in the project as you were working on the project. And my answer was always, yeah, we don't cover that. It is kind of an addition required by GAAP. It starts with the end of the regular income statement, and it has some adjusting items there. And so we're not going to be covering that, but if you were just curious, because you've seen that in the annual report you've been analyzing this semester, obviously you're welcome to look at that appendix, but you're not responsible for anything that's in there. It's not in the exercises, it's not in the problem, it's not on the homework. It won't be on the exam. Down to the bottom. So, questions before we dive into the chapter? Okay. So, what we're going to be looking at as we analyze financial statements is helping us to answer questions. We're decision makers. What kind of decisions are we making about this company using the financial statements? And you can see here on the screen 3 different areas that we might be interested. 2 of these 3 we've talked about frequently throughout the semester. Liquidity, having enough money to pay our bills when they come due. Just if I can get it to change screens, I will do that. So liquidity. In my summary, having enough money, having enough cash to pay our bills when they come due so that we can get our employees to continue coming to work because we're paying them, to get our suppliers to continue selling us whatever it is we need to run our business because we're paying them, being able to pay our tax obligations as well. And so liquidity is a big question for us. And we'll be looking at a series of financial statement analysis ratios or calculations that speak to that question of liquidity. The second category is solvency. So this is more of a long-term focus. Liquidity is a short-term focus. Solvency is a long-term focus. Can we meet our long-term obligations? And this might include things like paying off bonds, paying interest to our bondholders, and so on. And then the third area is profitability. And again, something we've talked about many times throughout the semester, making money, generating a positive net income on our income statement. And remember, we've said really the difference between liquidity and profitability for our purposes is profitability uses the accrual basis of accounting. So we can be making money on our income statement and still have a liquidity, a cash flow issue because maybe our customers aren't paying their bills in a timely fashion or something like that. And so profitability looks at the income statement. Much of what we're going to be doing in this semester, in this chapter, are ratios where we're comparing one value from our financial statements to another one. And usually we're expressing that as a percentage or a number of times. But we're going to start out this chapter looking at some analytical methods where we look at the financial statements as a whole rather than looking just at individual categories or individual lines on those financial statements. Our very first exercise then is going to be related to a vertical analysis where we look at the entire financial statement and compare the relative size of each of the categories. I've mentioned this before in an earlier chapter, probably around chapter 5, when we talked about current ratio and working capital. So anytime we are looking at an analysis, trying to say, how are we doing, or how is this company doing, we need to always be thinking of that question, well, how are we doing compared to what? We have to compare to something. And there are 2 here on the screen, but I've given you 3 different standards of comparison. The one that's not here on the screen is comparison to a rule of thumb or a heuristic. So kind of a bright line where we say, no, if we're better than this, we're probably okay. And if we're lower than this, we might be in trouble. It's a yellow flag, something we need to look into further. Not all of the calculations we'll be doing in this chapter have that rule of thumb that works for most companies across most industries. Some of them are very, very industry specific. So profit margin, for example, the profit margin in a grocery store is in the low single digits. If a heavy manufacturing firm had profit margins in the low single digits, they'd be out of business. So sometimes, again, we'll have that rule of thumb or a heuristic. The other 2 comparisons, as you can see here on the screen, are how are we doing compared to last year? How are we doing compared to the last 5 years? What's our trend look like? And then the third category of comparison, or the third standard for comparison, is how are we doing compared to our competition? So we may look at an industry average if we're able to identify an industry where we operate, or we may pick just one competitor who might be number 1 in our industry, and we say, how close are we to being like that company? So keep in mind as we work through these exercises that sometimes we may just calculate one number, and it's impossible to say whether that one number is good or bad because we always need to be comparing it to something else. So we can't look at any single number and say, oh, that's a good number. Good compared to what? We have to know what we were doing last year or what our competition is doing. Or maybe there's that rule of thumb that we can use as a comparison. But there always has to be that comparison in order to make the statement about, is this good or bad? As I said, we're going to start with the analytical methods, and you can see 3 different versions of analytical methods here on the screen. We're going to be working through each one of these, and unfortunately, the exercises that I have chosen, I do not have in the same order that they are covered in the PowerPoint. So I think for consistency, we'll do them in the order that they're in the PowerPoint so that I don't have to keep jumping back and forth. It's easier to change in the exercises than it is to change up the order in the PowerPoint. So we will start with horizontal analysis. And that means exercise 4. So if you do not already have your See Now exercises open for chapter 14, please go ahead and open those now. And our first exercise will be exercise 4, looking at horizontal analysis. So we can do horizontal analysis on the income statement and on the balance sheet. Those are the typical statements that we would be reviewing using this technique. Horizontal means side to side. We're looking side to side. We are comparing 2 years worth of data, and we are going to show 2 different pieces of information to compare those 2 years worth of data. We are going to show the dollar amount or the absolute change, and then we're going to show that as a percentage of the older year in our data. So this is an example of what the horizontal analysis of a balance sheet might look like. I should point out, we see a word here at the top of the screen and at the top in the heading of this financial, of this analysis. This is not a financial statement on its own. It's an analysis of a financial statement. The heading uses the term comparative. Now, that is not something you would normally see at the top of your financial statements. Most of you, if you look at the financial statements for the company that you chose for your project, most of you may see the word consolidated in front of the name of the financial statement. And that's a totally different concept than comparative. Consolidated means that your company is the parent company and they own at least 50% of the outstanding common shares of some subsidiary company. So the requirement is, if you have a controlling interest, that is, you own more than 50% of the stock, you have to add those financial statements of the subsidiary or the child company in with the financials of the parent company. So that's what it means to consolidate the financial statements, that you are including not just the parent company, but one or more subsidiaries as well. Again, that's wholly different than what we're looking at here. The term comparative is a GAAP requirement. GAAP requires that you provide at least 2 years worth of data on your financial statements to allow this comparison to happen more readily. So one of the questions that you've been asked in a couple different chapters of the project is, how many years of data are on the financial statements? How many years of data are on the income statement or on the balance sheet? And all of you have seen that your companies have at least 2 and sometimes 3, and sometimes maybe even more than that if the company's trying to show some kind of a more long-term trend. The most I have ever seen, a few years ago, a student used Dollar General for their project, and at least that year, Dollar General had 5 years worth of information on their cash flow statement, but usually it's 2 or 3. Obviously, companies can voluntarily choose to include more than 2 years worth of data, but the minimum requirement under GAAP is 2. If they only provide 2 and you want to see more data than that, it's a very simple process to just access the previous year or 2 years or 3 years or 5 years ago. The financial statements are generally available right on the company's website for the last several years at least. So looking at this horizontal analysis of a balance sheet, you can see we have the 2 years worth of data. As we pointed out before, the newer year is generally to the left, And then the older year is the right hand, the second column. Then we have two new columns added on, which is what makes this horizontal analysis. We have the dollar amount of change or the absolute change, and then we have the percent change or the relative change. That's a percent of the older year or the base year's data. We can do a horizontal analysis on an income statement as well, following that same process. So we still have the two additional columns, dollar amount and percent change compared to the older year. I think I have right there, oops. So here's an example of a horizontal analysis of an income statement. And with that, we are going to go to our first exercise for today. Exercise 4. Any questions, though, before we turn to our first exercise? Okay. So we have the data from their income statement. And this is for Winthrop Corporate Company for the two most recent years. In part A, we are given those same data. Thankfully, we don't have to just retype them in. That would be not a good use of our time. All we need to do then is calculate the increase or decrease as a dollar amount and then as a percent. Excuse me. And so let's do the first couple together, and then we'll pause and let you complete the rest on your own. Then we'll come back together to talk about how helpful is this? What do we use this for? So to calculate the increase or decrease, to make sure that you're showing it as a negative if it's a decrease and a positive if it's an increase, you want to calculate current year minus previous year. So that's going to be the dollar amount because there was an increase from last year to this year, we show it as a positive. If it was a decrease, make sure you use the negative. Then to calculate the percent change, we're simply going to take this, oops, try to do this. We're going to take this amount and we're going to divide it by, oops, we're going to divide it by the previous year. So we have the dollar amount of change that we've already calculated, 240,000, and we divide by the older year, the previous year, $2 million. And it asks us to round to one decimal place on the percent if required. So we can just put 12, but if you prefer that they are all in the same format, you can also put 12.0. For the purposes of these calculations, when you can see that they use negatives already, please disregard those negatives. So do not put into your calculator negative 1,925,000 minus a negative 1,750. That will not give you the correct sign. If there was an increase in the cost of goods sold, which there was, our cost of goods sold is higher in the current year than it was the previous year, we want to show that as a positive. And again, please disregard the negative when calculating the percentage as well. And we want to show that as a positive when there was an increase. Everybody okay with how to do these calculations? Any questions? So I'm going to pause the recording at this point to allow you to complete the rest of this table, the rest of the the horizontal analysis. Once you get the percentage for net income, please go ahead and restart the recording. So we have all of our dollar amount and percentage changes in now. I didn't click the check my work because I don't want all those gray boxes cluttering up our field of vision here. I'm fairly confident my percentage that I got the math part right, even though I'm back to using my cell phone calculator for today. So what do we do with this? How do we use this? Remember, the whole point of doing this is to help us make decisions. So what kind of decisions about the company might we be able to reach based on this information? Well, it helps us to see, for example, that while their sales went up by 12% from the previous year, their cost of goods sold went up only by 10%. So their revenue is increased faster, at least, than the cost of the merchandise that they're selling, which is a very good thing. And that is why our gross profit increased even more than sales did, because our cost did not go up as quickly. But then when you come down to the operating expenses, the selling and administrative expenses, you can see that the increases in those exceeded the increase in our revenues. And so our total operating expenses went up by 20.2% when our sales only went up 12%. And so that ends up not being a positive situation for us. We'd like to be able to control those expenses a little bit better. So that gives us something to consider, something to target. If we work for this company and we're trying to see how can we do better, we might look at that and say, oh, we better look at our operating expenses and see if we can maybe do a better job of controlling those. But even with that, you'll notice that their operating income, which is the income before income tax, and their net income went up by 78%. That's a huge jump. And that is, again, attributable to the fact that their revenues went up more than their cost of goods sold. Those two dollar amounts are much bigger than the operating expenses. And so that increase in sales had more of an impact on our bottom line. When we get to the vertical analysis, we'll talk about that kind of concept again. But remember, the person, the decision maker using these financial statements could be inside the company, could be outside the company. And so if you're inside the company, you're looking at this information to help us recognize maybe how better to manage the company to be more profitable or more efficient. If you're outside the company, you might be making a decision about, should I invest in this company? Should I lend them money? What interest rate should I charge? How risky are they? Or maybe even something like, would I want to work for this company? Are they doing better? They seem to be on good financial footing? Let's go ahead and answer the questions here in Part B. The net income for Winthrop Company increased between years. This increase was the combined result of an increase in sales and a lower percentage increase in cost of goods sold. So we already talked about that. The cost of goods sold increased at a slower rate than the increase in sales, thus causing the percentage increase in gross profit to be higher or greater than the percentage increase in sales. Now we can put our green check marks in there. So that is an example of a comparative income statement with horizontal analysis. I showed you an example of how we would do the same thing with a balance sheet as well. Any questions on that before we move on then to a vertical analysis? Okay, so we'll be going back to exercise 1. But I'm going to go back to our PowerPoint as well. And we'll talk about vertical analysis and take a look at exercise 1, 2, and 3 here in a minute. So vertical, of course, means up and down. So when we did horizontal analysis, we were comparing 2 columns of data side by side, so that would be 2 years worth of results. When we look at vertical analysis, we're looking up and down, which means we're only comparing within 1 year. So we're comparing different categories on the financial statement to the other category in the same year. We can do a vertical analysis of a balance sheet or an income statement, just like we saw on the previous, on the horizontal analysis. So for the vertical analysis, what we do is set an item, the largest dollar amount on the financial statement, we set at 100%. So what's the largest dollar amount on an income statement? It's going to be revenues or sales, right? And so we set that at 100%. And then within that same column, within that same year, we express the other categories. So cost of goods sold, selling expenses, administrative expenses, gross profit, operating income, income tax, net income. We would set all of those, we would calculate what percent is that of our total sales. On the balance sheet, the largest number actually appears in 2 different places. The largest number on the balance sheet is the total assets, but it's also equivalent to the total liabilities plus equity. And so we set that number at 100%, and then we express each of the individual items, cash, inventory, receivables, property, plant, and equipment, land, equipment, whatever, all the different categories. We say, what percent is this of the total assets? Or on the liability and equity side, what percent is our accounts payable of our total liabilities and equity? So you've already been doing a little bit of that on some of your projects when you're asked, for example, what percent of the total current assets was receivables, or what percent of total assets was cash. So you've already been doing that a little bit, one item at a time. What we're going to be looking at in exercise 1 is the entire income statement, looking at the breakdown of the categories. Here's an example. Here's an example of vertical analysis of a balance sheet. We'll get to the income statement in a moment. Just threw me because I've just been talking about income statement. So you can see the total assets is set to 100%. Now we do have 2 years side by side here, but these percentages are all within the year 2016. And then these percentages are all within the year of 2015. So we set the total assets at 100%. Then we look to each individual category. So we go to our current assets, we take the dollar amount of current assets and divide by the total assets. And we find that current assets make up 48.3% of our total assets. We then, after we've done both years, then we can start to do the comparison. Well, in 2016, current assets made up 48.3% of our total assets. In 2015, it was only 43.3%. We can disregard the dollar amounts. So we're not looking at, this was a $17,000 change. We're looking at how does the composition of our assets change from year to year, really disregarding for this purpose, the dollar amounts. That's why this is sometimes referred to as a common size financial statement. If we were to take out these dollar amount columns altogether and just have the percentages, it would allow us to compare our company, if maybe we're a much bigger size or much smaller size from one year to the next. maybe we bought out another company. And so just comparing the dollars, every dollar amount is going to be higher than last year because we are not the same company we were last year, but we can still compare the percentages. It would also allow us to compare to another company more readily. So if you are a small computer company, a small, cell phone company, and you want to compare yourself to another cell phone company, and you look at Verizon's financial statements, well, compared to Verizon, you're a very small company. So it's going, if we just compare the dollars, you're going to be behind Verizon in every single category, right? But if we use this vertical analysis common size and only look at the percentages, yes, Verizon has more cash than we do, but as a percent of total assets, do they have more cash than we do? It allows us to compare two companies of very different size, and that can be very worthwhile for us. Let's go to the income statement. And as I already pointed out on the income statement, we're going to set sales to 100% and then express each of the categories below that, each subsequent line as a percent of that sales. So again, we take the dollar amount here for cost of goods sold, divide by sales, and we get 69.6%. So all of these are percentages. Just like with dollar signs, we don't need to include the percentage after every line. We only need to include it when we're taking a total like that. So same rule that applies that we talked about back in January for where do we put dollar signs. You don't put a dollar sign on every line. You don't need to put a percent sign on every line either. It's understood. And I already mentioned the idea of common size, and this is what that would look like when we take out the dollar amounts and we just focus on the percents to allow us to compare Lincoln Company to Madison Company, which may be much larger or much smaller, but this allows us to get an idea of how do we compare in terms of the composition, the relative sizes of the various categories on our financial statements. For example, just to show you one here. For Madison Corporation, they're paying 5.5% of their sales as income tax, where Lincoln Corp, whoops, sorry. Why it just did that? Normally if I've got that on, it won't. There we go. Normally it won't change slides when I have that on. So they're paying, Madison Corporation is paying 5.5% in income tax, 5.5% of their sales. And Lincoln is paying only 4.8% of their sales as income tax. However, Madison Corporation's net income is 9% of their sales. Their profit margin is 9%, and Lincoln's is only 6.1%. That's pretty significant to us. Why is that? Why does that happen? Because their selling expenses and administrative expenses are higher for Lincoln as a percent of sales than for Madison, about 4% higher. And that equates to a direct hit to the bottom line. Any questions about what we've just said? Now we're going to go to our first exercise, our next exercise, which is exercise 1. Let's do that. And we're going to do the vertical analysis of the income statement. So we have our revenue and expense data here. That information has already been plugged into the income statement for us, but we do need to calculate some totals. So let's go ahead and do that first. Cost of sales minus cost of goods sold will give us gross profit. Then we have selling and administrative, so we can total those, add those two together. We subtract total operating expenses from gross profit. We get operating income or income before income tax. And then the bottom line will be net income. So let's do the first column together. So remember, unlike when we do the horizontal analysis, when we're comparing one year to the next year on the same line, we're now only doing these calculations for the current year, and then the previous year calculations are done completely independent of the current year calculations. We don't involve the 2 years. We're just looking up and down in that same column. So gross profit will be sales minus cost of goods sold. Total operating expenses, and I should probably put the negative in there. Total operating expenses is going to be the sum of selling and administrative expenses. We then subtract that amount, total operating expenses, from the gross profit to get our operating income. And then we subtract income tax to get our net income. So nothing new there. We know how to do a multi-step income statement. We learned that in chapter 5. Now, this is the part that's new. The current year, we are doing a vertical analysis. So we set the largest number, which is sales. We set to 100%. We are asked for this exercise to round to the nearest whole percentage. And so we're not going to be using any decimal places on the percents. So we start with 100% for sales. And then for each line after that, we take the dollar amount and divide by the dollar amount of sales. So for cost of goods sold, we take the cost of goods sold, $2,280,000, and divide by the $4 million in sales. You can show those as a negative if that helps you to remember to subtract. It's okay. It's not wrong to not use the negatives. And for this exercise, the software doesn't tell us to use negatives or not, which generally means it will accept either one. Now for this next line, we have 2 choices. We could take the gross profit in dollars, $1,720,000, and divide by the sales. But because of the way the income statement works, because this is a subtotal, we can actually just subtract. 100% minus 57 must be 43% was the gross profit, which is faster. I'm all about doing things the more efficient way if it saves time and gives us the same answer. But if you aren't sure, if you want to do the entire math expression, 1,720,000 divided by 4 million, you'll get the same answer either way. Now for selling expenses, we take the total selling expenses of 600,000, divide by the 4 million in sales. Everything is dividing by the 4 million in sales. Again, you can use the negative or not. Do the same thing for administrative expenses. And now this is the total operating expenses, which is simply the sum of the selling and administrative. So it's okay just to add those 2 percentages. Or you could take the total dollar amount and divide by the total sales. Operating income is gross profit minus total operating expenses. So again, you could just 43 minus 28, or you could take this 600,000 and divide by 4 million. Or maybe you recognize, hey, there's another 600,000. It has to be the same percentage. Any one of those is going to work for you. Income tax expense, then 240,000 divided by 4 million is 6%. Again, you can use the negative or not. And for the final line, you can simply do 15 minus 6 is 9. Or you could take the 360,000 divide by 4 million. Get the same answer either way. And so that is the vertical analysis of an income statement. Any questions at this point? Okay, so I'm going to pause the recording and ask you to do the previous year calculations on your own. Once you finish these two columns, please restart the recording and we'll go through the final questions in part B. Okay, so we've now completed all of the entries for the previous year, and now we see how do we use this? And the whole point isn't just to create these statements, but to have something to, some decisions we can make or some conclusions we can draw about this company and the changes from one year to the next. So what do we see? As a percent of sales, cost of goods sold increased. As a percent of sales, cost of goods sold went from 52 to 57%, which means their gross profit also went down by 5%. Their total operating expenses held steady at 28% of sales, so that's a good thing. But because of that increase in their cost of goods sold, their operating income went down by 5%. And so their net income also went down by 5% as a percent of the sales. So it doesn't mean that it went down by 5% in dollars from the previous year, but as a percent of sales. So let's fill in our answers then to part B. The vertical analysis indicates that the cost of goods sold as a percent of sales increased by 5 percentage points, while selling expenses decreased by 3% and administrative expenses increased. So I hadn't pointed that out. I pointed out that they stayed steady in total, but there was a shift from more in the selling expenses to more in the administrative expenses. Thus, net income as a percent of sales decreased by 5 percentage points. So that's the kind of analysis that you might find beneficial if you work for this company and you're trying to figure out, why did our income go down by 5% as a percent of sales? Why did our profit margin go down? Well, it went down because our cost of goods sold increased more than our revenues. What do we do about that? Well, that's not a question we can answer here in class, but one question you would have to be asking if you worked for Innovation Quarter is, well, did we have an increase in our cost from our supplier that we did not pass along to the customer? Can we raise our prices to reflect that increased cost? That's not always the answer, because it might be if we know from the law of demand in economics, if we raise our prices, we're going to sell less of it. But the question is it worth raising our prices? Will it make up for the loss in the units that we sell? And we cannot answer that in class. But those are the kind of questions that this vertical analysis would help us to isolate. We might not notice if we just look at the dollar amounts. We might not notice that our cost of goods sold as a percent of sales went up. We might not notice that our gross margin as a percentage went down if we only look at the numbers. And so doing this vertical analysis may help us to discover something that will help us run our business better. Let's go on then to our second exercise, which is the common sized income statement. So we already pointed out the common size income statement is basically the vertical analysis that we just did, only we remove the dollars altogether so that we are just comparing percentages. So that allows us to compare ourselves to other companies who might not be the same size as we are, where comparing dollars to dollars is not going to give us any meaningful information. In this exercise, Tannenhill Company wants to compare itself to the average. So remember, we said, in addition to that rule of thumb, there are two different standards of comparison. We just saw one of them in exercise 1, where we're comparing ourselves to ourselves. How are we doing over time? In exercise 2, we're comparing ourselves to an industry average to see how are we doing compared to the average company. So here we have our common sized income statement. We would not normally put the dollar amounts here. Normally it would just be the percentages side by side. But by keeping these dollar amounts here, excuse me, it will help us not having to scroll up and down to pick up the dollars that they gave us up here. So we're going to prepare the common size income statement and then answer a couple questions down here, fill in a couple blanks down here at the bottom. So we start with, because this is a vertical analysis, we always set the largest amount to 100%, so that would be sales. If this were a balance sheet, and we'll see this in the next exercise, if this were a balance sheet, the number we would set to 100% is the total assets. And now we're going to express each one of the subsequent lines by dividing that dollar amount by total sales. So 2,120,000 divided by 4 million, and it doesn't tell us here whether to use decimals or not use decimals, so I will start with not using them. See how that goes. As I suggested, you can put in the negative or not put in the negative. I'm going to put in the negative to be consistent with what's in the electronics industry average column, so that doesn't distract us from what we're trying to see. We just go down the list. As we know, we can just subtract there to get the gross profit percentage. Or we could have done 1,880,000 divided by 4 million. You'd get the same answer either way. And so once we have all of those percentages in, now that we have that column completed, we can compare to the electronics industry average. And again, how do we use this to help us analyze our company? So we might be working for Tannenhill and we're trying to help to manage the company better. Or we might be looking for an investment in the electronics industry and we're wondering if Tannenhill might be a good investment. So we might look at this, comparing them to the average electronics company. So we remove the size of the company. So Tannenhill company had $4 million in sales, but this would allow us to compare to a company that had 40 million or $400 million in sales, because we remove that size component and we're only looking at the percentages. So as a percent of sales, Tannenhill's cost of goods sold is significantly lower than the industry average. They get a better markup or a higher markup on their product, which gives us a higher gross profit. And you'll see, even though they spend a little bit more than the industry average on their operating expenses, that does allow them to, because of that higher markup on their product, that higher gross profit, it does give them a higher operating income and ultimately a higher net income as well as a percent of sales. So the company is managing the cost of manufacturing product better than the industry. they get a higher markup, and has slightly higher selling and administrative expenses compared to the industry. The combined impact causes net income as a percent of sales to be better than the industry average. So even though they spend more on their operating expenses, the fact that they save money on their cost of goods sold, or they get a better markup on their product, means that their bottom line is healthier as a percent of sales. Okay, so any questions about how to do these calculations or how we might use them to help us make decisions about the company? All righty. Let's move on then. We're going to exercise 3, which is vertical analysis of a balance sheet. So we already saw the difference between vertical analysis and common size is that the vertical analysis is still including, or does still include, the dollar amounts. So this is the first common size or vertical analysis we've done of a balance sheet. So we'll do the current year together, and then we'll pause and let you try the previous year on your own. So the process for a balance sheet is we set the largest number, that is total assets, we set to 100%. Now they've made the math super easy in this column by having the total assets be 10 million. So calculating the percentage is going to be pretty straightforward. We just have to reposition the decimal place. So it's 25% for current assets. That's 2.5 million divided by 10 million. 5.6 million divided by 10 million would be 56%. And then 19% for the intangibles. You can see that those 3 numbers, because those are the 3 categories we have in our assets, those 3 numbers must add up to 100%. And we'll see that same relationship on the credit side of the balance sheet, that is the liabilities and equity. We set total liabilities and equity to 100%. And then we divide each one of the categories by that total liabilities and equity. You can also think of that as dividing it by total assets if that seems easier to you. It's the same number. So 2 million is 20% of 10 million. 3.4 million is 34% of 10 million. We have a bit of a decimal point there, first time. It does tell us to round decimal percentages to 1 decimal place. We wanted to be consistent, I guess. We could have put in the point zeros here if that feels better to you. I like to have my decimals line up. Any questions about how to calculate those numbers? Again, set the 2 largest numbers to 100%. And then express each one of the other lines as a percent of that total. I'm going to pause the recording now to allow you to fill in those percentages on your own, and then please restart the recording. And so now we can see the 2 years side by side, and we can look at the numbers and see, yes, our current assets increased. But how does that compare to the total assets? And not only did our current assets increase by over $6 million, it increased from 20% of our assets to 25% of our assets. And so we've become more liquid. Our assets are closer to being cash. At the same time, our property, plant, and equipment went down as a percent of our total assets, went down by 10%, and intangibles went up by 5%. So that information, and we can do the same thing on the liability side. At the same time, our current assets went up by 5% of assets. Our current liabilities went up by 5%. What might have happened there? Well, if we work for this company, we could easily find out what happened there. I'm just speculating based on what I'm seeing here. It may be that they had something that was a long-term liability that is now a current liability. You'll notice our long-term liabilities went down by $280,000. So that at least would partly explain the increase of $620,000 in current liabilities, because the long-term liabilities, part of them became current liabilities. And so it's a good thing we have additional current assets, because we have some liabilities that are due this year and we need to be able to pay for them. Our stock stayed the same in terms of the dollar amount, but it went down as a percent of our total liabilities and equity, or total assets. But our retained earnings went up. We made some money last year that we did not pay out as dividends. And so again, being able to see these as percentages rather than just dollar amounts maybe allows us to more readily see those changes in the composition of our assets or the composition of our liabilities and equity, and make a better informed decision whether we are inside or outside the company. Any questions on what we've done so far? Vertical analysis, horizontal analysis, common size financial statements. I'm going to move ahead then to the other part of the chapter. And so the next part of the chapter, I can just jump over here. Oops. I might want to just make a comment about these. So let me just start here for a moment. The next part of the chapter is looking not at the financial statements as a whole, but focusing in on individual pieces of those financial statements. Excuse me. So our next exercise is going to be just looking at receivables and analyzing receivables. I want to do a bit of a review, though. As soon as I hand sanitizer here. I'm going to do a bit of a review. What we're going to talk about in the next couple of slides is more of a macro level or bird's eye view before we get into the initial or the individual components of the financial statements. This is review because we talked about this back in chapter 4 when we first introduced the classified balance sheet. We said that one of the 3 areas that companies are interested in and decision makers are interested in knowing is the liquidity of a company. And current position analysis answers that question in part. So in the next couple slides, I'm just going to review these 3 calculations. Again, we've seen these in the earlier chapter. These are, I think, maybe the only 3 calculations that we did in the earlier chapters. We talked about lots of the ones we're going to cover today and Monday, but we actually looked at calculations for working capital. So once we have that classified balance sheet, we have separated out the current assets from our longer term assets, and we've separated our current liabilities from our non-current liabilities. And that allows us to directly calculate working capital. Working capital then is expressed in dollars, and it is the dollars we have in our current assets that aren't already earmarked that we don't need to cover our current liabilities. And so working capital essentially tells us how much of a cushion or float do we have, how much leeway do we have if something unexpected comes up. If it turns out that something costs more than we were anticipating, we hadn't built that in, how much protection do we have? And there's just an example of calculating working capital. You can see for Lincoln Company their working capital did increase from year to year. Now, when we just look at the working capital as a dollar amount, though, that doesn't tell us maybe everything we want to know. If we didn't see what went into it, we wouldn't know how does that working capital compare to our current liabilities. So for a company Lincoln's size, $340,000 in working capital is a lot, right? They have a big cushion there compared to their current liabilities. That should cover them if something unexpected or unplanned comes up. But if we didn't know the relative size of the company, then having another way of calculating or getting at that question of how much cushion do they have is by looking at the relative size, doing a comparison, and that comparison would be the current ratio. So it uses the same dollar amounts from the balance sheet, but instead of expressing the difference in dollars, we express the ratio. And this would be expressed in number of times. So same categories, but you can see that rather than saying we have $240,000 in working capital, we would say their current ratio is 2.6. See that. So right here, their current ratio is 2.6. What that means is for every dollar in current liabilities, they have $2.60 in current assets. Now, current ratio is one of the ratios, financial tools, that we do have a rule of thumb. And the general rule of thumb for current ratio is anything greater than 1.6, or 1.6 or greater, I should say. The company's probably fine. And so, to say that another way, if it's less than 1.6, we might be worried about that company. Their liquidity might be in question. So what do we do with that? Some companies might have a current ratio of 1.3 or 4 and be perfectly fine. And another company might have a current ratio of 1.8 and still struggle with their liquidity. So that's why it's called a rule of thumb. It doesn't work for everybody. It doesn't work for every company in every industry, but it's a starting point. Okay, so that's current ratio. And then the last one is quick ratio. And the quick ratio removes those current assets that are not financial assets. So inventory, for example, would not be included in the numerator of the quick ratio, because we can't use our inventory to pay our bills, right? We have to do something with it first. We have to sell it and then get our customers to pay us before we have the cash to pay our bills. So the quick ratio is sometimes called the acid test, and it is a much more immediate, can we pay our bills right now? Or do we need something else to happen first, like selling that inventory? So quick assets are basically our financial assets. It's not going to include prepaid rent. It's not going to include the inventories. We have a rule of thumb for quick ratio as well. And the general rule of thumb for quick ratio is anything greater than 1.0, we're probably fine. We have enough quick assets to be able to pay all of our current liabilities right now. So we're not reliant on something else happening first. So you can see as we compare Lincoln Company and Jefferson Company, they both have working capital of 340,000, and they both have a current current ratio of 2.6. But when we look at what's on their actual balance sheet, you'll notice that, Lincoln Company has inventories of 264,000. Jefferson Company has inventories of 380,000. And so just based on that alone, Jefferson's quick ratio is going to be lower and possibly indicate a liquidity issue for for Jefferson with that higher inventory. And so you can see here, excuse me, you can see here for the quick ratio, for Lincoln Company, it's 1.3. That is higher than what I said was kind of the magic number of 1. And Jefferson's is lower than 1, indicating a potential liquidity problem. Okay, so as I said, that was just review. We're not doing those calculations right now, but we have seen those starting in chapter 4. So I want to move on then to our next exercise, which is for our next, maybe all of our exercises that we have left. Just doing a quick check here. Yep. So for all of the exercises we have left, rather than looking at the balance sheet as a whole or the income statement as a whole, or even as we just discussed, all of the current assets, all of the current liabilities, for all of our remaining exercises for this chapter, we're going to be looking, zeroing in on a specific quantity on the financial statements compared to some other specific one number on the financial statements. And we're going to start with accounts receivable analysis. Excuse me. In the receivables chapter, which was chapter 8, I mentioned both of these calculations as we talked about managing receivables and setting our credit policy so that it's not too loose, so that we're losing cash, so that we're allowing customers to buy on credit who maybe aren't going to pay us, but we also don't want it so tight that we're losing sales. And so this receivables analysis is going to help us with that question. How long are our customers taking to pay us, and what impact does that have on our overall operations? So this is a part of the liquidity analysis. It gets to how quickly our customers are paying us. Excuse me. Accounts receivable turnover. You can see the calculation there, sales divided by average accounts receivable. So in just a moment, we'll be going to exercise 5 and doing this calculation. So you may want to make a note of that formula. Sales divided by average accounts receivable. And I want to check something because I'm having this thought that possibly I put a formula sheet in Blackboard for you already. So let me just go to the reference materials folder for chapter 14. Yeah, good. So in the chapter 14 reference materials folder, these are just snips from the book, but they include all of the calculations that we're going to need for this chapter. So the 3 we just reviewed, working capital, current ratio, quick ratio, and now receivables turnover. I'm going to give you just a little bit different calculation for the number of days sales in receivables. The calculation that's here absolutely works. I don't want to steer you wrong. I don't want to sound like this is not the right calculation. It is. It just requires a little bit more work than the way I'm going to show you to do this. But I would suggest that you keep this in mind. Again, all the formulas are in the book, but this is an easy reference. You're already, I hope, used to going to the reference materials folders in Blackboard. So these are in here for you. And over on the right-hand side, it tells you, how do we use this? What do we do with that information? So let's go to our next exercise, accounts receivable analysis. Xavier Stores Company and Lestrade Stores Incorporated are large retail department stores. Both companies offer credit to their customers through their own credit card operations. Information from the financial statements for both companies for 2 recent years is as follows. And these numbers are in millions. So we're not going to be using that label, but we certainly do not need to be putting the extra zeros on there, because accounts receivable turnover is a ratio. And so if we divide millions by millions, that label, I don't know if they use this term anymore, but the label cancels. So it simplifies. So it doesn't, as long as all of the numbers are in the same terms, in this case millions, we can disregard that. That's true for all of these calculations with the exception of working capital, which is actually expressed in dollars. It's not a ratio. So the formula that I just showed you for accounts receivable turnover was sales divided by average accounts receivable. And so we need to know how to calculate that average. So to find our average accounts receivable, we take the ending balance plus the beginning balance. And you can, obviously you can do beginning plus ending. I'm sure you're all aware that addition is commutative. That means it doesn't matter. 4 plus 3 is the same as 3 plus 4. So ending plus beginning, beginning plus ending, same thing. And then because we're adding two numbers together and trying to find their average, we're going to divide that by 2. So it is a straight or arithmetic average. We're simply adding two numbers together and then dividing by 2. So for Xavier, our average accounts receivable would be 820,000, whoops, dear, plus 880,000. Make sure you group that together. So if you are using a calculator that follows order of operations, as it should, if you don't put the grouping symbols, the parentheses or the brackets around that, you're going to end up dividing just the second number by 2. One way of checking your answer for reasonableness is when you average two numbers together, the answer, the result, needs to be, must be, somewhere between those two numbers. It should be exactly halfway between those two numbers, of course, if it's not a weighted average. Everybody okay with that? So the average credit card receivables for Xavier for this year, $850,000. Beginning of the year, it was 820. The end of the year, it was 880. It may have gone up and down during the year. We have to use the information we have available to us. And the information that we have available to us is the beginning and ending balance. So we add those two together, divide by 2. Now we can find the accounts receivable turnover. By taking our total sales and dividing by the average receivable. Again, they made that math nice and easy for us. 10 times. Xavier's accounts receivable or AR turnover is 10 times. It says to round to 1 decimal place. In other words, they collect, on average, they collect their receivables in full 10 times a year. It's one way of reading that. Is that good or bad? I don't know. Compared to what? I don't know how long when they sell on credit, I don't know how long they tell their customers that they can pay. Remember in chapter 5, we talked about payment terms. So I don't know, did they tell their customers pay in 30 days, pay in 10 days, pay in 60 days, 90 days? I don't know. So it's impossible for me to look at that 10 times and say, is that good or bad? We have to compare it to something. Before we go on to the straight, and I'll ask you to do that on your own, let me just show you, I told you that I would give you what I think is an easier way. It is an easier way of calculating the second computation, which is the number of days sales in receivables. Another description of that you may see is days sales uncollected. It means the same thing. So number of days in receivables. I'm just trying to simplify that, shorten it up. You absolutely can use the formula that was provided to you in the Exhibit 13 that I have in the reference materials folder. However, that would require you to calculate the average days sales by taking the $8.5 million and dividing by 365 days to find out how much do we sell in a day. There's a much simpler way to calculate this since we already know the receivables turnover. And so here's my simpler way of calculating this. We simply take the 365 days there are in a year and divide by the receivables turnover that we already calculated, which happens to be 10. And you'll get the same answer whether you use my simplified formula here, 365 divided by receivables turnover, or if you use the formula that's in Blackboard for you. So 36.5 days is a little bit easier for us to comprehend. This is number of days sales in receivables or days sales uncollected. But one way of interpreting this is, on average, it takes our customers 36.5 days to pay their bill. So now we can compare that to something. Are we telling our customers that they have 30 days to pay? If they're taking 36.5 days and we tell them 30 days, they're slow paying. That may indicate we need to tighten up our credit policy a little bit. Questions, anybody at this point? All right, so I'm going to pause the recording and allow you to do the Lestrade calculations on your own. You have the formula for the average accounts receivable up at the top, and then you can plug that into the accounts receivable turnover formula, and finally into the days, number of days in receivables. I'm going to pause the recording. Restart, please, once you have those two numbers. So the first thing I did was calculate the average accounts receivable by adding the 600,000 from the beginning plus the 710 to the end, from the end. And I found their average accounts receivable was $655,000. Divide that into their sales, and I got an accounts receivable turnover of 7 or 7 times. On average, their customers pay their full accounts receivable 7 times throughout the year. If I then divide that into 365, I find the number of days sales and receivables to be 52.1. So now we can answer these questions. Xavier's accounts receivable turnover is much higher than Lestrade's. The number of days sales and receivables is higher for the, for Xavier. It's lower for Xavier than for Lestrade. That's always going to be the case. They're inversely related. That's very clear in the simpler formula that I explained to you. If you put the receivables turnover in the denominator, in that calculation, it's always going to give that inverse relationship. Higher turnover means fewer days sales uncollected. These differences indicate that Xavier is able to turn over its receivables more quickly than Lestrade. As a result, it takes Xavier less time to collect its receivables. So as we're comparing these two companies, we would recognize that Xavier's liquidity is better than Lestrade's when it comes to their receivables. Now remember, I told you that this exercise and all of the remaining exercises that we will do on Monday, these are very narrowly focused. We're only talking about receivables here. If Xavier said take 60 days to pay and their customers are paying in 36.5 days on average, that might tell you that their credit policy is too tight, that they might be losing sales to those customers that might take 45 or 50 days to pay. On the other hand, if Lestrade is telling their customers to pay in 30 days and it's taking on average 52, that might tell you that their credit policy is too loose, that they're lending to people, essentially selling on credit to people who are paying them slowly, and that has a dramatic impact on their liquidity. So we're halfway through the final chapter. We will stop here for today. Does anyone have any questions or anything else you want to talk about before we call it a day? All right, well, as always, thank you for being here. May the 4th be with you. I want to make sure everybody noticed today's date if you're a Star Wars fan. See you all on Monday.
Have a good day.
You too, thanks.